Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of April 15th. So over the last couple of weeks, I've been previewing key economic data and talking about whether or not the Fed will cut rates soon. So let's instead pivot to something else. Let's talk about another key market driver, in this case, corporate earnings. As a reminder, companies generate earnings. Investors tend to buy the shares of those companies with stronger earnings. So late last week, the earnings season started for the first quarter, and we saw some major banks release earnings that were a little mixed. So today, I want to discuss this earnings season right now and why we're optimistic. In other words, why we think earnings will be better than expected. First of all, what is expected for earnings? According to FactSet, and FactSet is a database that compiles earnings estimates, they expect the S&P 500 earnings to rise 1.1% in the first quarter. And overall for 2024, they expect earnings to rise 11.2%. The largest earnings growth this quarter, they expected to come from growthy sectors like communication services, technology, and consumer discretionary. Also utilities, because utilities should benefit from poor earnings a year ago. The weakest areas that they're seeing is earnings coming in weaker in energy, in healthcare, and in materials. All are expected to see a 20% decline in year-over-year earnings. So second point, what do I think? I think earnings will prove stronger than expected this quarter for three reasons. Number one, if you look at this chart, the economic surprise index, data is coming in better than expected. Economic data is exceeding expectations. This chart shows the Citi Economic Surprise Index. Whenever a data point comes in above expectations, the line moves higher. Whenever it comes in below expectations, the line moves lower. As you see here on the right-hand side, the data, the economic data is getting better. And this is especially evident in manufacturing. If you look at goods and manufacturing, though they're only about 20% of our economy, they represent about 50% of S&P 500 earnings. And as you see here, evidenced by the PMI, which is a survey from purchasing managers, manufacturing and goods are stabilizing and improving after being in recession for over 15 months. Second point, profit margins are stabilizing. As you see here, if I use PPI, the Producer Price Index, as a proxy for business costs, and if I use CPI, the Consumer Price Index, as a proxy for business sales, business costs are falling at a faster clip. This is very margin positive, good for earnings. And the third point is that companies beat expectations in the fourth quarter. Earnings were up about 4%. Remember the environment in the fourth quarter? It was very deflationary. That's good news. Companies were able to beat earnings expectations in a weaker inflation environment. So the key takeaway, markets have been very focused on the Fed, but another key driver that you can't forget is corporate earnings, and we are very optimistic about earnings. With this in mind, this all ties to our thesis. Given the fact that we see high valuations in the stock market, given the fact that the Fed is pretty uncertain in terms of when they will cut rates, this could lead to a pullback in the stock market. But strengthening corporate earnings is one reason why we feel any market pullback should be short-lived. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and I'll see you next week, and thank you for watching.